So we all know that the Feds have finally cut rates by 50 base points last week. Since then, the stock market and the mortgage rates have both gone up. Lots of different voices and opinions on the internet about what's going to happen to our economy and the housing market. Are we heading into a recession with huge housing market crash, or is the home price going to go up again? In today's video, I'm going to share with you what are some of the main arguments from internet gurus and experts that support either side, and what I think, whether there are right or missing points. And finally share with you what I think so that at the end of this video, you can arrive your own logical conclusions. Hello everybody, this is Bojie He, your local Bay Area real estate expert, and welcome back to my channel. And if this is your first time visiting my channel, don't forget to like and subscribe for more future real estate related contents from me. Now, let's get into the recent rate cut topics. I know there are a lot of speculations from online world saying that the Feds have waited too long, or the decision has more political motivations than pure economical driven decision. I share some of the similar doubts, but that's not what we're going to discuss in today's video. Rate cut has already happened. Is it going to work as intended? Which direction is the market heading to? And are we going to have a soft landing? What about the real estate market? These are all questions that consumers are wondering every day. And I have done a lot of research on my end as well. And what I found online is that 30% of the online contents have pessimistic views on the economy, and 40% are optimistic, and another 30% are really uncertain at this point. So let's look at some of the common reasons that each categories of experts or influencers use to support their positions. Now let's start from the bearish influencers. Their number one argument is a market correction due to overvaluation. Now, this view often hinges on the idea that the price growth in recent years have outpaced the fundamental factors like wage growth and affordability, making the market vulnerable to adjustment. Experts like Mark Zendi from Moody Analytics, big-time YouTube investor YouTuber Ken McElroy, and Nick Gurley from Revenue Consulting all share similar viewpoints on that. My thoughts? Well, this one really depends on the specific local market. Certain markets have appreciated so much because of investors from California or New York have been buying homes there, and the current price there is indeed more than the local income can support. These markets are definitely overvalued, and that I 100% agree. And these markets are definitely vulnerable to bigger correction, but not necessarily a big crash yet. And markets like Bay Area, where I'm at, I believe that the correction has already taken place. The current price of Bay Area homes are about 10% less than the pandemic's peak. And even during the peak, most of the multi-million-dollar homes here have been bought by the locals. Bay Area's high local income is a solid support to the high local home prices. So because of that, while I agree that overvaluation can lead to price correction, but I don't think that Bay Area homes are overvalued yet. So on this one, I maintain my optimism. The second argument from the bears is economic uncertainty and recession risk. This is an obvious one. If the economy slows down and companies are laying people off massively, it would definitely affect the housing market negatively, causing home prices to fall. Lawrence Yun, the chief economist from NAR, Robert Shiller, the renowned economist, and David Rosenberg from Rosenberg Research all shared the same bearish outlook on the economy, particularly due to the rising recession risk. Now, for me, recession definitely is not a good thing, but it does not automatically mean a housing market crash, although it can be one of the triggers. The 2008 recession was sparked by homebuyers overextending their credit and taking on excessive debt through risky mortgage loans, which led to what became known as the subprime mortgage crisis. The same thing is unlikely to happen at this time. According to Bloomberg, nearly 40% of the homes in America now are paid off completely. Therefore, it is rather unlikely that the next recession will cause another massive wave of foreclosures. But again, it would depend on how bad the recession is and what area would have the higher unemployment rates and how high it is. Again, markets that are potentially already overvalued, like above mentioned, will probably get hit the hardest and could potentially experience 30% or more price drop, which is considered a market crash. But here in the Bay Area, things will be a little different. I believe that most of the Silicon Valley's core cities market will be just fine with minor corrections, possibly, while areas with more blue collar demographic could experience a bigger correction. So on this one, while I acknowledge and understand their bearish outlook on the economy, but I am more optimistic about real estate market should the next recessions occur. Now, let's look at some of the bullish perspectives online. Number one, improve affordability. The bullish influencers believe that the Fed's rate cut could potentially cause the mortgage rates to further drop, and when they do, buyers' affordability will improve, and therefore, more buyers will be buying homes, which causes the home price to go up. This is what most real estate professional online or offline believe. Me personally, although a lower mortgage rate can definitely help with home prices, let's not forget though, rates aren't as important as consumer sentiment or fears about the unemployment situation. And this goes back to the outlook on the overall economy and the job market, which nobody has a crystal ball. So my conclusion on this argument is that rates aren't everything, so don't be too optimistic on that yet. Number two is the housing supply shortage. When mortgage rate goes down, the bulls believe that it is likely that more sellers will want to move again by putting their homes on the market. Although this will increase the home supply, it would also create more buyer competitions too. In most of the coastal cities where lands are scarce, the housing supply issues will remain. And this will continue to be one of the reasons for home values to appreciate in those markets. For me, I am 100% with this theory. However, as time goes by, different generations will evolve and adapt. Are the next generation of buyers going to keep fighting for the traditional single family style ownership, or will they turn to co-living, tiny homes, and other alternative housing models in order to adapt? So, in other words, the housing shortage issues may be solved by consumer adapting to a different lifestyle and hence different purchasing preferences. This could mean that different housing product might be in more demand than traditional housing in the future should the traditional housing shortage issues worsen. This could change the future of real estate economy altogether. With that, I would place myself in the 30% uncertain group when it comes to predicting housing market's future. There are simply way too many mixed signals from the economy right now. For instance, while there are reports saying that the inflation is cooling, but the core inflation remains persistently high, this raises the possibility of further Fed's intervention, which could negatively impact both consumers' confidence and the housing market. Then the labor market is another point of confusion. On one hand, the Fed assures us that the job market is healthy, yet they're also discussing significant rate cuts, which suggests underlying concerns about the potential economic troubles. Moreover, while some housing market may be overvalued, persistent supply shortages and strong demand could prevent a significant price drop, making it difficult to foresee either a crash or a sustained boom. Adding to the uncertainty are emerging factors like evolving housing preferences among younger generations, shifting migration trends such as a remote worker being asked to go back to the office, and international issues like the Middle East tension and China's economic slowdown. These variables create a highly unpredictable economic landscape. I mean, I don't want to be over optimistic nor pessimistic. I suggest to stay in the middle. Don't be overly aggressive with your investment and don't easily panic either. Things aren't as bad as what some of these online clickbait wants you to believe. Just focus on long-term investment and make sure you manage your risk accordingly. The Bay Area's real estate market has seen an uptick in activities as mortgage rates have dipped over the past few weeks. This has brought more buyers back into the market compared to earlier, resulting in an increase in home sales. If rates continue to decline into spring 2025, as many expected, we could see a very active market next year. For those considering selling, now might be a good time if you want to avoid competitions from more sellers when the market becomes busier. On the other hand, if you're looking to buy, you can either wait for the rate to drop further, though that may lead to a bidding war, which was similar to the past market conditions, or take advantage of the current more balanced market. And you can always refinance later if the rate indeed drops. Anyways, that's it for today's video. Hope you enjoy it. And don't forget to like and subscribe to my channel for more real estate contents like this. And if you have any questions about real estate in the Bay Area, buying or selling, feel free to reach out and I would love to chat. All right. Thank you for tuning in and I'll see you on the next one.